Hey, good morning, everyone. Welcome to our webinar. Obviously, it's Saturday morning, so we're going to get started in a couple of minutes. We have people that are logging in and signing in, so it's going to be an exciting webinar. It's going to be a short one. Usually these workshops we conduct either at local colleges and universities like FIU, Florida International University, and Nova Southeastern University. And normally a workshop like that will take anywhere between 2 to 2.5 hours because we go very, very deep into the subjects that I'm going to be discussing with you today. So today's webinar, as you all know, those of you that signed up for it, is how to avoid the torpedo tax in retirement, which is one of the major issues that most of us are going to have to deal with when we get to retirement. So get ready, make sure you have some coffee or water. Happy Saturday again to all of you. I'm excited to be here. I'll tell you a little bit about myself. For those of you that have never seen me before, you'll learn a little bit more about myself and my company and what we do and so forth. But it's not about me today. It's not about my company. Today it's about you. And today is about giving you as much information and education as I possibly can. Because at the end of the day, one of the things that I tell a lot of my clients and a lot of the people that we engage in seminars and podcasts and webinars and video conferences that we do is that although there's more information in the marketplace than ever before, Americans are worse off than they've ever been. And the reason for that is simple. Information without education always leads to failure. So as I can see, there are more and more people that are logging in as we speak. So I'm going to give it another 30 seconds or so. I have my water. I already had my coffee this morning. I already worked out this morning. I normally get up early, even on weekends. So obviously it's a Saturday. But I normally wake up at 5:30, 6 o'clock in the morning, and I always try to do something, either go to the gym and lift weights or go out for a run, you know, whatever it is, because at the end of the day, I want to be as healthy as I possibly can for as long as I possibly can as well. All right, so let me see. All right, so we're ready to go. Again, welcome to our webinar. My name is Bert Salazar, and I am going to be your host today. For those of you that don't know much about me, obviously I've been in the accounting and financial services industry for about 30 years. I own a company called Gables Tax Planning Group, and you know, we do accounting, bookkeeping, payroll services. We also do retirement distribution planning and tax planning for small business owners all throughout the United States, obviously including Florida as well. And today's webinar obviously is going to be a very important one because it's going to deal with, you know, how to avoid not only the torpedo tax in retirement, but how to avoid so many other different types of taxes. For those of you that may be interested, we are going to be hosting a seminar, an educational seminar at Florida International University in Miami. And the address is 11200 Southwest 8th Street, the School of Business, and the room number is going to be 254 here in Miami, Florida. So for those of you that may be interested in attending, it's going to be on August 20th and August 22nd from 6:30 p.m. until 8:30 p.m. So feel free to reach out to me and I'll send you all the information and an invitation. You can either send me an email at Bert, B-E-R-T, at gablestaxgroup.com, or you can also call me at area code 786-766-1042. And that's going to be a really packed event full of tremendous information and education that all of you can take with you in order to maximize your retirement income while you're minimizing your tax liability in retirement. All right, so what I'm going to do now is I am going to give you access to my desktop so you can see my desktop and you can watch, you can actually see the presentation that I'm going to be sharing with you. Just to give you a little bit of feedback, I will be going fairly quickly through a lot of the topics that we're going to be covering because again, we only have an hour in order to do this, and there's a lot of stuff to be covered. I'll leave a little bit of time at the end for any Q&A. Otherwise, you can just send me an email because we're not allowed to go into any specifics because of the fact that we have many of you on the call. So we have to stay fairly general. So again, Bert Salazar, and I'm going to be your host for this webinar today. And this webinar, as I stated earlier, is going to be on how to avoid the torpedo tax in retirement. Again, I'm not associated with the Social Security Administration. I don't work for Social Security, for the Social Security Administration and or the Internal Revenue Service or the IRS. I am a tax preparer. I specialize in tax planning. And I also specialize in retirement distribution planning. And I've been doing this for the last 30 years. But obviously, it's always good to use a disclaimer so you'll know that I don't work for Social Security Administration or for the Internal Revenue Service. Also, I am a member of SOFA. And I'm very proud to be a member of SOFA. So SOFA is a Society for Financial Awareness. And it's one of the largest 501c3 nonprofit organizations in the United States. And what we do is we promote financial literacy throughout the United States. And we do so through these types of workshops that we do at colleges, universities, public libraries. We try to avoid hotels because we don't want to come across as trying to sell anything because this is an educational workshop and we like to keep it that way. We also get hired by small, mid-size, and major Fortune 500 companies to come in and provide financial literacy education to their employees. So I'm very proud to be a member of the South Florida chapter for SOFA. And again, for those of you that may want a little bit more information, feel free to log into www.sofausa.org. And be able to have access for a lot more information. And those of you that may own a business or work for a company, and you may be interested in bringing some of the educational workshops and programs that we do on an ongoing basis throughout the United States, please feel free to reach out to me and I'll be able to help you along those lines. Now today, there are probably 200 workshops being held throughout the United States. So I'm proud to be part of that great organization. Now, what are the goals for this short webinar that I'm doing for you today? Number one, I think it's important that all of us understand the relevant changes under the 2017 Tax Cuts and Jobs Act. It's important to note because all of us are going to have a tremendous opportunity, but also a very short window of opportunity in which to maximize everything that you're doing from a business and tax planning perspective. We also want to understand the impact of the TCJA, which is how it's called, on retirement income streams. And you're going to be able to identify certain tools and strategies that are going to be able to help you and your family maximize your retirement income while minimizing your tax liabilities. The one thing that we're definitely going to stay out of is we're going to avoid all the political mumbo jumbo that are going out throughout, the United States today, and we're going to be sticking to the facts because at the end of the day, that's all that matters. Now, there are some commonalities between what I do on a regular basis and obviously tax planning. So the first one is, there's a commonality between tax planning and a colonoscopy. Nobody wants a colonoscopy, but everybody else needs it. So nobody wants it, but everyone needs it. So tax planning is the same thing. Nobody wants to do tax planning, but everyone needs it. So it's important that you make that analogy, although it's a funny one, but it makes a lot of sense from a business perspective because at the end of the day, if you don't do proper tax planning prior to retirement, then you're going to be paying the price, and your family is going to be paying the price for many, many years to come. The second analogy that I like to make is the one regarding the sinking of the Titanic. And the challenge with the sinking of the Titanic, and I love the history of the Titanic, so I've done a lot of reading all throughout my career, my business career, is that if you can imagine, the Titanic had hit the iceberg. It had less than 2 hours in which the Titanic was going to sink to the bottom of the Atlantic Ocean. And you still had many of the employees on the Titanic rearranging the chairs in the dining room. So although the Titanic was sinking, the vast majority of employees were rearranging the chairs in the Titanic. The question for you is, how many of you are rearranging the chairs to your Titanic? Because if you continue to do the same thing that got you into trouble today, what makes you think that you're going to be able to accomplish something totally different? So taking a very clear outlook of your finances through a telescope as opposed to a microscope is going to give you the aptitude to make certain that you're able to fix any things that may be sinking your financial Titanic from a business standpoint. And then obviously the other commonality is the fatal four of retirement. And this is one of the areas that we specialize in working with our clients, which is managing your retirement finances through a risk management approach. And there are four major things that can happen to all of you. We're not going to have the time to be able to cover them, but the four are the risk of a premature death, the risk of living too long, the risk of living with a disability, and then last but not least is the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, many different issues that will erode the value of your money as you embark on your retirement life. So obviously we don't have the time today, but if you come to one of our workshops, then we're going to go very deep into these areas that most Americans have never thought about as they prepare for retirement. Now, the thought of the day for all of you is that the problem with our tax system is not that Americans pay too little. And that's what all politicians want us to believe. The problem with our tax system is that the government spends too much. And you know who said that many, many years ago? Well, the 40th president of the United States, Ronald Reagan. And today is more true than it's ever been before, because, although Americans continue to pay a tremendous amount of money in taxes, our government continue to spend above and beyond what they should be spending from a legal and from a tax planning perspective. Now, one of the bold promises that we try to make, whether you attend one of our webcasts or one of our webinars as the one that you're attending today, or even one of our live seminars that we do throughout the state of Florida, is the one bold promise that we make is that we're going to help you increase your retirement income while reducing your tax liability. If you follow the things that we're going to be talking about today, then you're going to be able to do that. And most important, you're going to be able to avoid that torpedo tax. And I know some of you are saying, well, Bert, what's a torpedo tax? We'll get to that in the next few minutes. So just hang in there, keep drinking your coffee. Make sure that if something that you like, if you have your iPhone, take a picture of it, and then you can send me an email, and then we'll be able to discuss it if we do a private consultation along those lines. Now, this workshop that I'm doing today is a two-part series. The first part is the education, which is the webinar that I'm doing for you today, same as if you were to attend one of my seminars. And then the second part is one that if you're interested in engaging me and my firm in holding a confidential strategy session, then I would be more than happy to do that for you. But that's something that's going to have to start on your side, not on mine. And it's important because part of the work that we do for SOFA, because of the fact that we can now talk about any specific company, any specific product, or any specific service, is that SOFA requires us to offer at no cost or obligation a confidential strategy session for those of you that are listening to us today. Now, who am I? Again, Bert Salazar, I'm the managing member or partner for Gables Tax Planning Group, LLC. I am also a certified financial education instructor, so I'm very proud of that certificate, which is something that is very, very important and has been very, very important to all of my clients for the past 30 years. Now, whenever we host one of these events, one question that we always ask, and obviously today I'm not gonna have the time to get feedback from each and every one of you that are listening to us, but the question is, what will you think a perfect retirement plan would be? And I try to get information from, most of the attendees in order to get a feel as to how it is that they feel or what they think a perfect retirement plan should be. From my standpoint, a perfect retirement plan has to have a number of issues that I have enumerated here for all of you. Number one, it has to have guaranteed income. If you don't have guaranteed income, you don't have a retirement plan. Second, it has to have longevity protection. That means that income, has to be there until the day that you and your surviving spouse, if you happen to be married, were to pass away. Because the worst thing that would happen to you would be if you run out of money before you run out of life, and then what are you going to do if you happen to be in your late 80s, early 90s, and you no longer have any income coming in? Number three, the income has to have some kind of an inflation hedging. It has to be able to continue to grow and stay ahead of inflation, so that way you and your family can maintain the purchasing power of your assets, your retirement assets throughout your retirement years. Also, it has to have tax-free income. And the more tax-free income that you and your family can have, the better off that you're going to be in retirement. And then obviously, number five is going to have some kind of a long-term care hedging. People are living a lot longer today than ever before, but just because people are living a lot longer today than ever before doesn't mean that they're going to be any healthier. The fact remains, and this is all based on the statistics that we have in this country today, that if you're married filing jointly and you're a 65-year-old couple and you're fairly healthy, there's a 25, or there's actually a 75% probability that one of you is going to need long-term care, and you're going to have to be in either in a nursing facility or a nursing home at some point in time in your life. A 75% probability. Also, there's a 25% probability that if you're a married couple today at the age of 65, there's a 25% probability that one of you is going to be alive at age 92. So you have to be able to plan for a lot of decades of retirement, and running out of money before running out of life is going to be very critical. And also, you need to make certain that you have some kind of long-term care hedging in order to mitigate those additional expenses that many of us are going to have to deal with at some point in time in the future. And then last but not least, it has to have survivor protection. So if I were to die tomorrow and I'm 85 years old, I need to make certain that my stream of income and my retirement does not die with me and continues for as long as my surviving spouse is alive at that point in time. Now, one of the analogies that we make is that of climbing a mountain. And one of the things that we talk about, and I go into details into this exercise, and I'm not going to do this today, but, if I were to ask all of you on this webinar today, what would be the number one goal of a mountain climber? I would argue that most of you are going to tell me is to get to the summit, to get to the top of the mountain. And although that is one of the main goals for any mountain climber, that's actually half of the goal. The actual goal of a mountain climber is not only to make it to the top of the mountain, but also to make it back down safely. And for those of you that have read a little bit about mountain climbing, Mount Everest is the largest and the tallest mountain in the world. And that is the ultimate goal for each and every everyone that happens to be a professional mountain climber, to make certain that they make it to the top of the mountain. The sad thing about making it to the top of Mount Everest is that 70% of the people that have died on Mount Everest have not died on the way up, have actually died on the way down. Now, how do you equate climbing Mount Everest to your retirement planning? Well, as you're climbing the mountain, those are your accumulation years. And those are the years that you're working. Those are the years that you're investing your money. Those are the years that you're putting money away into your retirement accounts, your 401ks, your IRAs, your 403bs, your pensions, your savings, your investments, your real estate if you happen to be a real estate investor. So those are the accumulation years. And then once you reach the summit of retirement, that means that that's going to be the day that you're going to retire and stop working. Then now you go from people at work to money at work. So now all of those assets that you have put away for retirement have to last you and your family on the other side of the mountain as you're descending the mountain, and that would be your decumulation years. As opposed to the accumulation, you now have decumulation, and you want to make certain that you don't run out of oxygen or you don't run out of money halfway down the mountain, because it doesn't really matter what you did before. If you watch football, you know, does anyone really care what the score is at halftime? Of course not. You know, what's the only score that counts? Well, the one that is the final score at the end of the day. And that would be how you need to start thinking about your retirement distribution plan. Now, we're actually going through a tax Armageddon. And again, we're not going to spend a lot of time on this, but I call this a tax Armageddon because if you look in the top left-hand corner, you're going to notice that the U.S. national debt today is north of $22 trillion and counting. Most important, if you look at the federal budget, we're bringing in about $3.4 trillion per year. So we have north of 22 trillion in national debt, which is the biggest we've ever had in the history of this country. Our deficit is enormous because we're bringing in approximately $3.4 trillion per year in revenue, but we are actually spending north of 4.4 trillion. So for the first time in US history in 2019, we're gonna have a deficit of $1 trillion, and that can only get worse every year thereafter. So 2020, 21, 22, 23 is gonna get worse and worse and worse. What's even worse in all of this, if you look at the very bottom, notice toward the middle of the page, notice the US unfunded liabilities. And the unfunded liability, and by the way, the definition of unfunded liability are all of those promises that the US government has made to all of us through Social Security, Medicare, Medicaid, Part D, on the prescription drug that was put into play by President Bush, and then the interest on the national debt that we can barely afford to pay today is actually at $124 trillion, and again counting. So that means that we are experiencing the biggest debt that we've ever had in this country. And it's going to get worse and worse as we move forward into the future. By the same token, although we have the highest debt in our country, if you look to the right of this diagram, and this is a historical diagram of our tax rates, we're actually living in the third lowest tax bracket in the history of our country. If you look to the far right. If you look to the far left, you notice that the lowest taxable historical rates that we've ever had was at the very beginning of the IRS and the tax code back in 1913. And it was fairly low at that point in time. It was about 7.5%. And it was not supposed to go any higher than 7.5% at that point in time. The second lowest, as you can see there, was during the Great Depression in the 20s and 30s, and obviously the government was forced to lower tax rates in order to help, get us out of the depression at that point in time. By the way, the highest tax rate that we've ever had in this country was during the Second World War, and that was approaching 94%. And if you go to the far right, you see where we're at today. Now, whenever I ask any of my clients, where do you think taxes are today? They tell me they're fairly high. and actually it's totally the opposite. We're at the third lowest. So if we have the most amount of debt that we've ever had in the history of our country, and we're living in the third lowest taxable history that we've ever had before, where do you think that taxes are going to be in the near future? Where do you think that taxes are going to be at in 2026 when the Tax Cuts and Jobs Act is going to sunset? Remember, the Tax Cuts and Jobs Act will sunset now in 7 years. So it will sunset December 31st in 2025. So when all of us wake up January 1 of 2026, we're going to find ourselves in a higher tax bracket automatically than we are today, because the tax rates are going to go back to the old tax law. But what I'm mostly concerned is, depending who's going to win the White House and who's going to have the power in Congress, where taxes are going to go. And I would imagine that taxes are going to have to double, or our country is going to go bankrupt. And that brings me back to this article that came out in Forbes, which some of the economists and the experts barely said, as you can read there. The problem is that there are not that enough high income earners to satisfy today's debt and deficits. That means that the middle income America will soon be the scope of the congressional rifle, because the poor have nothing to tax. The middle class will be forced to pay the vast majority of taxes in the United States moving forward. And I would argue that most of you on this call today, and most of the people that attend our seminars and webinars happen to be middle class Americans. Now I need to use a disclaimer now, because we're going to get into some of the tax rates that we're seeing today. Those are not my parents, but that was exactly how they looked when they started to look at their retirement income streams, and when they started to look at taxation at the point in time that they retired. They were totally puzzled, they were totally confused. So I'm going to try to bring a little bit of light to all of you along those lines. Now, under the new tax law, and this is the Tax Cuts and Jobs Act that was signed into law in December of 2017 by President Donald Trump, to take effect January 1 of 2018. By the way, those of you that just finished filing your taxes in April, it was the first year that you file your taxes under the new tax law. So now in 2019 will be the second year that you will be filing taxes under the new tax law. Notice there that we have a progressive tax system. The more income you make, the higher the tax bracket. But I want to call your attention to the right of that slide, which basically talks about the ordinary income tax rates. And in making a comparison between the old tax law and the new tax law, please notice that the 10% always stayed at the 10%. The 15% became the 12% under the new tax law. The 25% became the 22%. The 28 now is the 24%. The 33 is now the 32%. The 35% stayed the same. And then the 39.6% under the old tax law is now the 37%. So not only did your standard deduction go up throughout the year under the tax rules, but also your taxable brackets went down. So most of you, if you were working for an employer, you were actually receiving a higher paycheck in 2018, every single paycheck that you received, compared to 2017. Now, this is how it looks if we map it all out. Notice that the biggest issues that we have here is we do have a major jump from the 12% to the 22%. And this is where probably 60% of the clients that we deal with in our firm fall into. So one of the things that we try to do is how do we minimize or eliminate that jump? And then we probably have another 30 to 35% of our clients that fall into the 24 and the 32% tax bracket. So that's another major jump that we want to try to avoid as much as we possibly can. Now, obviously, we just covered the ordinary income tax map, and this is your capital gains map. Now, capital gains enjoy certain benefits that ordinary income taxes do not. And that's because of the fact that whenever you have a capital gain, that means that you actually placed your money at risk. And if you do so, then the IRS is going to give you certain tax benefits and certain tax breaks. So in this situation, if your capital gains is between $0 and $77,200, you would pay $0 of capital gains taxes. And I'm going to show you an exercise toward the very end that is going to really make a big difference in how you're going to start to look at your retirement distribution income streams and how to prepare so you can minimize your tax liabilities in retirement, as I made that bold promise to all of you at the very beginning of this webinar. Now, if your capital gains are between $77,201 and $479,000, that's enormous. That's an enormous capital gain. Then you're at the 15% tax bracket, and then anything over $479,000 would be taxed at 20%. And again, here's the tax map for capital gains. So if you have a choice between having ordinary income taxes or capital gains taxes, then obviously the common sense decision would be for you to enjoy capital gains taxes as opposed to ordinary income tax rates. Notice that there's a 0 to the left, and that's because of the standard deductions and certain credits that most of us get every single year, depending on your deductions and such exemptions and credits that are afforded to you under the IRS code. And again, we're not going to get in deep into deductions, exceptions, and credits today because we don't have the time to be able to do so. But what I will be able to tell you is be aware that deductions and exemptions reduce your tax, reduces your your taxable income. Credits reduce your tax liability. So deductions and exemptions will reduce your taxable income, and that is reported for income tax purposes, but your credits will reduce your tax liabilities. Now, obviously, one of the major exemptions that was done away with in 2018 under the new tax law was the $4,050 for just being alive that all of us, when we file our taxes, we would be able to claim. And the reason why that was done, that was because obviously we received an increase in the standard deduction. Now, if the tax system were to stop at that point in time, then life would be good. The problem is that the tax system for us gets a lot more complex. And one of the major things that all of you are going to have to deal with would be your required minimum distributions. Those of you that have monies and qualified plans are going to have to deal with, and your required minimum distributions are distributions that will commence at age 70 and a half, whether you want to or not, whether you need the money or not. And if you don't, then you're going to have to pay an enormous tax penalty if you don't take the required distribution. So let me give you a quick example. Obviously, once you reach the age of 70 and a half, it will now trigger that distribution. And then what you do is you're going to take a look at your prior year's ending account values for your IRAs, your 401ks, your 403bs, etc. And then you're going to divide that by a specific rate. It's a uniform lifetime mortality rate that the IRS and the government uses. So you're going to have to use that formula in order to determine what is the minimum amount that you're going to have to start taking out of your retirement accounts in order to avoid the enormous penalty that you're going to pay. So in this exercise, let's say at the end of, we're dealing in 2019. If you turn 70 and a half in 2019, then you would have to look at your account values at the end of 2018. So you look at what happened on December 31st of 2018. If the account value was 500,000, then you're going to use the formula for 70 and a half, which would be 27.4. So you're going to divide 500,000 by 27.4. And the distribution for you out of those accounts would have to be 18,248. Now, for the first year and the first year only, the IRS allows you to, if you turn 70 and a half in 2019, to either take that distribution of 18,248 in 2019, or you may be able to push it forward to 2020. And if you do so, then you have to take the distribution by no later than April 1st of 2020, April Fool's Day. Depending on whether to take it in 2019 or 2020 depends on your fast forward calculations and your tax forward calculations that you're going to need to make. For some of you, you may be able to delay it and be a benefit to you. For others, you're better off taking it now. And the reason for that is that if you delay taking your 2019 RMD distribution until April 1st of 2020, in 2020, you're going to have to take the regular 2020 distribution no later than December 31st of 2020. So if you delay your 2019 distribution, then in 2020, you will have to take two distributions. The one that you delayed in 2019 plus the 2020 distribution moving forward for many, many years and for as long as you live. Now, the uniform lifetime table that I've been talking about, where we use that ratio of 27.4, as you can see there, you're going to have to apply it every single year as you move forward. So as you get older, notice a distribution period is reduced, or the rate is reduced. So at age 71, it will be 26.5, but it would be 26.5 over a smaller number and so forth, and then 25.6 and so forth. Now you can always take more, but you have to do these calculations, or your accountant has to do these calculations in order to make certain that you avoid the penalty. Because if you don't take the amount that you're supposed to take, you're going to have to pay taxes on that amount that you didn't take that you should have. And on top of that, you're going to have to pay a 50% penalty on the amount that you failed to realize. So the IRS is, in fact, very serious about you taking your required minimum distributions on time. Now, we're not going to spend a lot of time on Social Security benefits, other than the fact that obviously when you get your report, for those of you that may not know this, you can log into www.ssa.gov, and you can create your own account, and then you're able to pull out your Social Security benefits. And then when you get your benefits, notice that there are always going to be three numbers there. You're going to have your PIA, which would be your primary insurance amount. In this case, in this exercise, is $1,680. It's also going to give you the benefit at age 80 if you delay taking distributions. Once you reach your full retirement age and you wait until age 70 for every year that you delay, then obviously you pick up an extra 8%. And then the benefit at age 62, which would be the soonest time that you can exercise your Social Security benefits, would be $1,159. Now, many of my clients, when they come to see me for the first time, they consider waiting until age 70 because they're only looking at it from an income standpoint. They don't look at it from a taxable standpoint. And this is what we're going to be covering today. You know, the impact of the taxation on your Social Security benefits, which, by the way, it is a torpedo tax. So the torpedo tax, a definition of the torpedo tax, is that tax is going to have a negative impact on your Social Security benefits that is going to force you to take more and more income out of your other retirement assets in order to offset that deficit. And by doing so, you may be depleting your assets anywhere between 5 and 8 years, between 5 and 8 years sooner than expected. So how is that torpedo tax calculated? Well, there's something called in the IRS code, which is a provisional income. So when you retired and you start taking your Social Security benefits, the first thing that you're going to have to do every year, and this is a formula that the IRS uses, they're going to take 50% of that Social Security benefit that you generated in that year. Let's say that you retire in 2019. So you're going to have to factor 50% of that Social Security benefit. To that, you're going to have to add your ordinary income. What if you continue to work on a part-time basis? Then obviously, or you continue to work full-time after you reach your full retirement age and also started taking Social Security benefits, you're going to have to report that income as well. And that would include your W-2s, your 1099s. That would also include your distributions from your retirement accounts like 401ks and IRAs. Even if you go past the age of 70 and a half, you would have to report your required minimum distributions as part of this calculation. You're also going to have to factor in your capital gains and distribution. So if you sold a piece of property, you sold a stock, that distribution is going to come into the formula to determine what percentage of the Social Security benefits, your Social Security benefits, is going to be taxed in retirement. And then last but not least would be income from non-taxable interest. And income from non-taxable interest would be an example of municipal bonds. So if you're receiving municipal bond income or from a municipal bond fund, yes, and that money that you're receiving is free from federal income taxes, but the distribution is added on to the calculations in order to determine what percentage of your Social Security benefits will be taxable in retirement. So obviously municipal bonds are not totally tax exempt because they could have a negative impact on the taxation of your Social Security benefits and also the premium that you pay for Medicare, for your Medicare upon retirement, because the more income that you generate, the higher your Medicare premium may be. Now, there are thresholds that the IRS give you, and these thresholds are not inflated through inflation. So more and more people every year are falling trap to the provisional income calculation and to the torpedo tax than ever before. So after you go through the exercise in the previous slide and you slide in your account gives you all those calculations, if the total income that you receive for the entire year, if you happen to be single, is under 25,000, then you will pay no taxes on your Social Security benefits. But if the income is between 25,000 and 34,000, then 50% of your Social Security benefits received will be taxable based on your tax bracket. If that income exceeds 34,000, then up to 85% of your Social Security benefits will be taxed in retirement. If you're married filing jointly, and all the income that you have when you file jointly falls under 32,000, then neither one of you will pay taxes as a married couple for your Social Security benefits. If it is between 32,000 and 44,000, then up to 50% of your Social Security benefits will be taxable. And if the combined income exceeds 44,000, then again, up to 85% of your Social Security benefits will be taxed in retirement. And that is a major, major torpedo tax that most of the clients that I engage and most of you on this call had never knew about before or had any knowledge thereof. So obviously there are a lot of things that you can do. We don't have time to get into the tax buckets other than I can tell you that the IRS has three major tax bracket buckets. You have your taxable bucket, you have your tax deferred bucket, and then your tax-free bucket. And the buckets are divided as such. You know, your taxable bucket includes all your savings, your CDs, your mutual funds. Your tax deferred bucket includes your 401ks, IRAs, your pensions, your 403bs. And then your tax-free bucket will include your Roth IRAs, your Roth 401ks, your 7702 plans, which are your cash value life insurance plans that enjoy tremendous benefits under the IRS code. And then last but not least, municipal bonds. But you see that I have an asterisk there because you have to be very careful in how much municipal bond income you're going to receive in retirement, because that could have a negative impact on your Social Security benefits. The challenge for the vast majority of clients that we engage, and most of you Americans, is the fact that most of your money happens to be in the taxable and the tax deferred bucket. And that creates all kinds of tax issues and all kinds of torpedo taxes that are coming to you at retirement, and there's nothing that you can do to avoid it. So the best thing that you can do is you need to start to prepare in order to start shifting a lot of that income or a lot of those assets that you have today, at least over the next 7 years before the Tax Cuts and Jobs Act sunset, and make sure that you shift those to the tax-free bucket and away from your taxable and your tax deferred bucket. Always remember that any income that you generate from Roth IRAs, Roth 401ks, and 7702 plans are totally exempt from taxation under the IRS code. And most important, they don't have a negative impact on your Social Security benefits in retirement. Now, we do spend a lot of time when we do a live seminar or when we do a longer webinar, but obviously we don't have the time today. So I just wanted to give you a flavor of what the torpedo tax is, and most important, what are some of the things that you can do. And then to finalize this workshop, let me share with you an exercise, and this is an actual client. And I'll give you more details. I'm not going to go into the history of this particular client. Obviously, I have changed the name to protect the innocent. But the takeaway here is that it is important to note that when you go from accumulation stage to the distribution stage, you have to make a paradigm shift, because it's not only about the accumulation rate of return, it is exclusively about the distribution rate of return and the taxation of that distribution rate of return. So the one thing that I can share with you before I go into this quick exercise is that when it comes to retirement distribution, not all retirement income is created equal. Again, let me re-emphasize that statement. Not all retirement income is created equal. So let me give you a fact, pattern, and scenario. And by the way, the calculation that I'm about to share with you, if you engage me on a confidential strategy session, which bears no cost or obligation to any of you, I will do, once you provide us with the information that we need, I will conduct a tax forward planning calculation for you and your family to help you, whether you decide to use our services or not, to help you minimize your tax liability in retirement. So we have this client that is now in retirement. They haven't taken any Social Security benefits because they want to allow those benefits to continue to grow. So they're now taking, $50,000 out of an IRA distribution. As a matter of fact, let me make it in a way where I can share, okay, and you can see a lot better now. Perfect. So they're taking $50,000 out of their IRA in order to maintain their standard of living. Now, they also have income coming in from Roth IRAs and Roth 401ks, so that income is excluded from taxation. So the only taxes that they're going to be paying now would be on the $50,000 of IRA distribution. Notice here that because of the $50,000 of IRA distribution, they are now in the 12% marginal tax bracket. Remember that there's a difference between the marginal tax rate and the effective tax rate. So in the marginal tax rate would be the last dollar that gets taxed on the distribution. So in this case, these clients pulled out $50,000 out of their IRA. So they're in the 12% marginal tax bracket. But if you look toward the bottom, notice that in the middle of the page, they had a tax liability of $2,430 on $50,000 of IRA income. So although their marginal tax bracket was 12%, their effective tax rate, as you look to the right of the total tax of $2,430, was 4.86%. So when I sat down with these clients and I said, look, how do you feel about paying $2,430 of taxes on $50,000? They said, Bert, we're excited because we're getting money out of our Roth IRAs and Roth 401ks and some of the 7702 plans that you've put together for us over the last 10 years. So therefore, we feel comfortable paying this, and we don't have any problem at all paying the $2,430 of taxes. So I said, well, what if we can improve that? And they said, Bert, come on, how are you going to be able to do that? I mean, $2,430 of taxes on $50,000, that's a pretty good deal. I said, well, just go ahead and embellish me for a few minutes and let me walk you through an exercise. So basically what I did at that time, I said, look, what if we start invading your Social Security benefits? Because at the end of the day, you know, it's about how much money you keep, not how much money you make. And when I did the calculation for these clients, their Social Security benefits was about $35,000, but they only needed a total of $50,000, and that's why they were taking $50,000 of IRA distribution in order to maintain their standard of living. So I said, well, what if we take $35,000 out of the Social Security benefits, and then we only need to take, instead of $50,000 out of the IRAs, as you can see there on the left, toward the middle of the page, you only need to take an additional $15,000, so 35 plus 15 equals 30. Now, how will that work when it comes to the taxation of your tax bracket for business purposes? Well, notice there that although in the first scenario, when they were taking $50,000 straight out of their IRA distribution, they had a tax liability of $2,430, and they were in the 4.86% effective tax rate. By shifting the distribution between Social Security and IRA distribution, they're now getting $50,000 of income, and by the same token, they have a tax liability of zero. And then the other thing that I did is, because of the standard deduction offset, I said, well, can we take more income out of this IRA account, and how much more income can we take and still not have to pay a single dollar of federal income tax? So in this situation, what we did here, compared to, notice that we were able to pull the $50,000, combination of the $35,000 and the $15,000 of IRA distribution, and the clients paid $0 of tax. Then I said, well, how much more can we take, as I just stated to you, and still pay no taxes? Well, in this exercise, we were able to take an additional $7,000. So not only is now the client not taking the $50,000, the client is taking $57,000 of additional income in retirement. So $22,000 out of IRA distribution plus $35,000 of Social Security benefits, and still not pay a single dollar of income tax. And because they avoided paying the $2,430 as you see there, and now they're taking $57,000 of income, they're actually pocketing $9,430, which includes the additional $7,000 of IRA distribution, plus the $2,430 that they didn't have to pay to the IRS. But you would say, well, Bert, how can that be? You know, how can you put money into a qualified plan in the tax deferred bucket, where the money goes in pre-tax, the money grows tax deferred, and then you have to pay taxes upon distribution? You know, how can you pull the money out tax-free? Well, that's where tax planning comes into play, and that's where standard deduction offsetting will come into play, and to help you offset that potential liability. So therefore, your net would be a zero tax bracket in retirement. Now, because of the fact that, remember, when we started this conversation on this and this exercise, the clients were very comfortable in paying that $2,430, but now, you know, they're very elated and very happy. Obviously, that means that they can pocket an extra $200 some odd a month in order to set aside for vacation. They can spend it. They can do whatever it is that they want to do. They can gift it to their children, grandchildren, whatever it is, if they don't need it. But they also have an additional $7,000 that they can generate. Now, in this case, a client said to me, well, Bert, we really don't need to access those additional $7,000 because we don't need them. I said, well, one thing that you could do is, what if you take that distribution and then convert those $7,000 to a Roth IRA? And if you do so, now you have the best of all worlds, because now you were able to put the money there pre-tax, the money grew tax deferred, you pulled it out tax-free, and then you converted it to a Roth IRA, which will now be tax-free income for the rest of your life. So, you know, how can you mitigate those circumstances and do anything better than that? And the answer is no, you can't do anything better. So the clients were very excited, very elated. You know, they had never thought about their distribution of their retirement assets in this manner. And then what I said to them, I said, look, you know, why don't we go through another exercise? Why don't we go through an exercise? I will say, since you were so happy at the very beginning when you came to see us for this review on an annual basis, and you didn't have any problem paying $2,430 in taxes. Now my question to you is, well, how much more distribution can we get out of the IRA accounts in order to equal the taxation of $2,430? So after we went through the exercise, notice that now we continue to take the $35,000 out of Social Security benefits, and now we can take an additional $36,000 of IRA distribution. And if you look to the bottom right-hand side of your slide, notice that when they came to see me for the annual planning meeting, they were generating $50,000 of IRA income. They were paying $2,430 in taxes, and they had an effective tax rate of 4.86. Now, after doing some tax planning, they're able to generate $71,000 of retirement income. So an additional $21,000 of income. Now their total tax is $2,436. So I only went over it by $6. And they have an effective tax rate, which is lower than the effective tax rate that they had at the $50,000 of IRA distribution, which was 4.86, and now is 3.43. So they actually netted an additional $20,994 for the same tax liability that they had when they first came to see me, based on their goals and objectives and how they wanted to start treating their distribution out of their assets. So you can see that if you do proper tax planning, your money's going to be able to last longer. You're going to be able to reduce your Social Security taxation to the point that there may not be any taxation of your Social Security benefits. And if you do it the right way, you would take your distributions out of your Roth IRAs, your Roth 401ks, your 7702 plans, your IRAs and your 401ks, and your Social Security benefits totally tax-free. So it wouldn't even matter where taxes would go in the future. And then the last quick exercise, just to leave you at this point in time, is one where in this scenario, we say, well, what if the clients, in this case, my clients had long-term capital gains? Well, you know, what happens if you have long-term capital gains because you have stocks that have appreciated, that you have the ability to sell, but you never wanted to sell them because you didn't want to have to pay a capital gains tax? Well, you know, let's look at this exercise. We have the same clients with $50,000 of capital gains at this point in time. And obviously, if you look at the tax map, they're able to generate $50,000 of capital gains and pay $0 in capital gains taxes and $0 as an effective tax rate, because of the fact that between $0 and $77,200, there is no capital gains taxation. So you're now able to maximize the distribution of your capital gains. But unless you do proper tax planning, you're never going to know this. And your accountant is not going to do this, and your accountant is not going to do any tax forward planning because they don't do tax planning. Accountants, for the most part, and they're great at what they do, they're always looking in the rearview mirror. So now let me finalize and give you even a better scenario. Let's say that you have $50,000 of capital gains, and now you also have $50,000 of IRA distributions. And if that is the case, well, take a look at the tax map. Now you have $100,000 coming in. So now you have capital, $50,000 of capital gains. You have $50,000 of IRA distribution. So now your income went from $50,000 to $57,000 to $71,000, now to $100,000, and your total tax liability is $2,430. Your effective tax rate is 2.43, which is lower than anything you've ever seen. And by the way, that $2,430 that now you would pay in taxes was equal to the $2,430 that you would have had to pay had you just stayed with the $50,000 of IRA distribution. So at the end of the day, obviously, my call to action to all of you, remember, make sure that you stop rearranging the chairs on your Titanic, on your financial Titanic. So if you want me to go ahead and help you with this, then obviously, you know, the definition of insanity is continuing to do the same thing over and over again while expecting a different result. So what is my call to action to all of you? Well, just give me a call. Give me a call, send me an email. I'm going to give you the information in the next 30 seconds. Let's engage and have a private consultation. There's no obligation and there's no charges for us to engage in that. And actually, if I do this tactical retirement blueprint, I am not allowed to charge you for those services either under the SOFA rules of engagement that I'm hosting this webinar under. So just give me a call. We can schedule a 30-minute video conference. And again, here's my number. You can call me at area code 786-766-1042. Again, 786-766-1042. If you have your cell phone, you can either write down the number or you can take a picture of the screen and then reach out to me. You can also send me an email at Bert, B-E-R-T, at gablestaxgroup.com. And if you send me an email requesting a 30-minute video conference or conference call, I will immediately reply to you, and there will be a link on my reply that you can click on, and it will take you directly to my calendar, in which time you will be able to schedule a 30-minute call with me, depending on your time availability at that point in time. You can always obviously visit our website at www.gablestpg.com. And again, I want to thank you. Let me take you off sharing so I can say goodbye to all of you. And again, thank you so very much for giving me an hour of your time on a Saturday morning, because obviously I know that all of you have things to do, and it's South Florida, so it's a beautiful day. So my wife and I are going to go to the beach and spend some time in the beautiful South Florida and South Beach beaches. So the one thing I do want to leave you with is always remember that when it comes to retirement distribution planning, the rules of engagement totally change. So you're going from accumulation to distribution, and you really need to understand those rules of engagement in order to minimize your tax liabilities while you're maximizing your retirement income. Lastly, I want to leave you with a thought that I think is a very important one, because this is how I leave each and every one of you whenever I do my podcast or my seminars, my webinars, my financial workshops that we do live on a monthly basis, is that my number one goal, and that of my firm, is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time. Have a great weekend, and we'll talk again soon. And again, if you want to attend our Florida International University workshop in Miami, coming up on August 20th and the 22nd, please feel free to email me, and I'll send you all the particulars and all the invitation and all the information that is going to be very, very suitable and very, very educational to all of you. Take care. Have a great day. Bye-bye.